Welcome to the deep dive. Today we're diving into Rezolve AI PLC. That's RZLEV on NASDAQ.
Yep, RZLV. And we're looking at it through sort of a value investing lens using the sources you sent over articles, reports, notes.
And right off the bat, something really jumps out. I mean, over $50 billion in gross merchandise value, GMV, processed just this year, 2025.
50 billion, yeah. It's a huge number.
But then you look at their 2024 revenue. It was reported as immaterial, like just $188,000.
A tiny fraction.
So how does that even compute? All that activity, almost zero sales reported. That's the kind of puzzle we're here to unpack for you.
Exactly. That's what the deep dive is all about. Taking your source material, cutting through the noise, and getting to the core insights. Helping you understand what's going on with Rezolve AI based on these documents.
And just so you know, all those sources we're talking about, articles, analyst reports, filings, they're linked down in the description. You can check them out yourself.
Definitely worth a look.
So today we'll explore their tech, the leadership, and there's some interesting history there, the financials, which look, well, challenging.
To say the least.
Where they fit in the market, the big risks, and maybe even how something like U.S. tariffs could play a role.
Yeah, that's an unexpected angle from the sources.
Okay, so starting with that massive scale versus tiny revenue, what does Rezolve AI actually do?
Well, they're positioned in the AI for retail and e-commerce space. Pretty hot area right now.
And their big goal.
According to them, it's nothing short of reinventing digital commerce. Ambitious stuff.
Okay, and how are they trying to do that? What's the core product?
It's called the Brain Suite. Think of it as their main package of AI-powered tools.
Gotcha. And the sources break that down.
Yeah, there are a few key parts. There's Brain Commerce. That's about making the online shopping experience better. Conversational search, real-time recommendations, that kind of thing.
Okay, like a smarter shopping assistant.
Yeah, sort of. Then there's Brain Checkout. That's focused on making the actual buying part easier, one-touch payments, trying to stop people from ditching their carts halfway through.
Cart abandonment, the eternal struggle.
Isn't it just? And finally, Brain Assistant. That's more the AI customer service side. Post-purchase support, using data to help out after the sale.
So covering the whole journey, basically.
That seems to be the idea. And underpinning all of this is their own proprietary tech, an LLM they call BrainPower.
BrainPower. Okay, and what's special about it? They must make some claims.
Oh, they do. Big claims. They say it's specifically trained for retail and e-commerce using unique data sets. And get this. They claim zero hallucinations for e-commerce content.
Zero hallucinations. That sounds optimistic for AI right now.
It's a very bold claim. And they also claim immunity to model drift.
Okay, let's unpack those. Zero hallucinations. For someone maybe not deep in AI, what's the practical meaning for a retailer using this?
Right. So AI hallucinations are when the model just makes stuff up. Says a product has a feature it doesn't, gives wrong info. For retail, that's bad news. It kills trust.
Yeah, you can't have your website lying to customers.
Exactly. So claiming zero means they're saying their AI is super reliable for those specific factual e-commerce tasks. And model drift, that's when an AI gets less accurate over time as real-world data changes.
So immunity means it stays accurate without constant fixes.
That's the claim. If true, those are huge advantages. Reliability and stability. Key differentiators, potentially.
Okay, that makes sense why they'd highlight that. The sources also mention some other things like Agentic Sidekick 3.0, AI TSM for ITHR.
Yeah, hints of broader AI work, but the main focus definitely seems to be that retail brain suite and, turning all that activity into actual money.
Right, which brings us back to the business model. How do they plan to get paid?
It's mainly B2B2C. They sell to the big platforms, the merchants, the payment processors.
And their customers use the AI.
Exactly. And the revenue model is expected to be software as a service, SaaS, tiered monthly fees, probably based on usage or features.
So let's tackle that puzzle again. $50 billion GMV, 16.5 million monthly active users early this year, but just $188K revenue last year? How are they bridging that?
This is the question for 2025. The sources point to that massive scale showing the tech works, it can handle volume. The problem wasn't capacity, it was converting usage into paying contracts.
Okay, so what changed? What are the specific things meant to fix that this year?
Two really big things highlighted in the sources. First, that $9.8 million annual contract with Liverpool, Mexico, that's real. Contracted revenue starting to flow.
Okay, nearly $10 million. That's a start. What's the second?
The acquisition of Group B Inc. back in March 2025. That
And
seems crucial.
Group B, tell me about them. Why is that deal so important?
Well, Group B already processes over $30 billion in annual retail sales volume on its own platform. Rezolve bought them for $55 million, all in stock.
Okay, and the impact.
The sources stress this deal is expected to add around $30 million in high-margin revenue for Rezolve just in 2025.
Wow, okay, so $30 million from Group B plus nearly $10 million from Liverpool, Mexico? That starts to look like real revenue.
Exactly. It changes the picture significantly.
Uh-huh.
And Group B also brings more tech, especially around site search and discovery, making Rezolve's whole offering more complete.
So they're betting heavily on these two things to transform the financials this year.
That's clearly the plan laid out. Their pitch to retailers is all about measurable ROI boosting conversion, higher order values, better customer lifetime value, smoother operations. They keep mentioning proven ROI.
And besides Group B, what else have they been up to since listing on NASDAQ last August?
Quite a bit, actually. Strategic partnerships with Microsoft and Google aiming for better personalization, omni-channel stuff, maybe lead generation.
Big names.
Yeah. And they mentioned some kind of crypto payment thing with Tether launching this year. Plus, signing up more big clients. The sources list over 50 enterprise customers. Names like KFC, Ace Hardware, Kohl's.
Okay, so building momentum on multiple fronts and financially. Any moves there?
Yes, some important ones. They converted $59 million of debt into equity late last year, raised $15 million in new capital, and secured access to a $30 million loan facility.
Strengthening the balance sheet, basically.
That's the narrative, but you have to note that debt conversion and capital raise also meant more shares were issued, diluting existing shareholders. Always a trade-off.
Right. Okay, so that covers the business, the tech, the strategy, but execution is everything. Who's running this company?
The leadership team and the board, they have backgrounds in e-commerce, tech, finance. Key names are CEO Daniel M. Wagner, CFO Richard Burchill, CTO Dr. Salman Ahmad.
And the board has some experienced non-execs too, right? People like Anthony Sharp, Sir David Wright, Dr. Steve Perry, who was at Visa.
That's right. Having those experienced independent directors could be really important, especially given, well, the history.
Yes, the history. Because the CEO, Daniel Wagner, he's had successes before, like Made and Venda.
He has, but he's also very well known for his association with Powa Technologies.
Powa. That was the UK tech unicorn that collapsed pretty dramatically back in 2016, right? After being valued at, what, $2.7 billion?
Exactly. A spectacular implosion. And the sources detail the reasons cited for Powa's failure, and it's relevant context for Rezolve AI.
Why? What were the issues at Powa?
Multiple things. Financial mismanagement was a big one. Reports of burning through huge amounts of cash, extravagant spending, not enough revenue coming in.
Okay, cash burn.
Then overambitious goals, unrealistic projections, making really bold claims about deals and tech that just didn't pan out. Remember that China UnionPay venture? Never really materialized.
I vaguely recall that. What else?
Operational failures, tech glitches, questions about whether signed clients were actually locked into paying contracts or just, letters of intent.
The difference between a signature and revenue.
Precisely. And finally, poor leadership decisions were cited, overexpanding too quickly, lack of tight financial controls.
So, connecting that back to Rezolve AI now.
Yeah.
What are the parallels we should be aware of?
Well, you see some potential echoes. Rezolve is making very ambitious claims right now that $100 million ARR target from basically zero. That's bold.
Very hockey stick-like growth.
Exactly. And they're clearly burning significant cash looking at their current losses. The Powa story just underscores how critical financial discipline, realistic execution, and actually converting customer deals into recognized revenue really are.
So the board's role becomes even more crucial to provide that oversight.
Absolutely crucial. It's not just governance. It's about ensuring those past patterns don't repeat. Their independence and quality are paramount here.
Looking at Rezolve's current philosophy, it seems very focused on aggressive growth,
right.
Leveraging that brainpower tech, partnerships, global reach.
Yeah, that seems right. And their capital allocation reflects it. M&A like Group B, using debt equity swaps, raising capital, investing in that growth.
And then there was that unusual move early this year, the $1 billion Bitcoin Treasury Initiative.
Yes. That was definitely unconventional. Announced in February 2025.
What was the reasoning given?
The stated purpose was to fuel the future of AI-powered crypto commerce. But for a company in their current financial state, allocating, even notionally, $1 billion tied to Bitcoin's value, it's a high-risk move. Adds another layer of volatility.
Definitely raises eyebrows. And what about corporate governance? Anything specific to know?
Yeah, as a UK-based company listed on NASDAQ, they're a foreign private issuer, an FPI.
Which means?
Different reporting rules than U.S. domestic companies. They file an annual report, Form 20F, instead of quarterly 10Qs. Generally means less frequent, maybe less detailed disclosure for U.S. investors. Things like insider trading reports might also be less frequent.
So something investors need to be aware of, the information flow might be different.
Exactly. Though the board structure, as we said, aims for that independent oversight.
Okay, let's switch gears to the financials because, as you said earlier, the picture here is challenging.
It really is, historically speaking. We mentioned the FY 2024 revenue was just $188,000, and the net loss, a huge $172.6 million.
Wow. And even the interim numbers for the first half of 2024 showed big losses relative to tiny revenue.
Negative $12.8 million loss on about $53,000 revenue. Yeah.
Now, one positive note in that interim data was decent gross margins on the service itself, right? Around 65–70%.
That's true. It suggests the core service could be profitable if they achieve scale. But the problem is the operating expenses are just overwhelming the revenue right now. Massive overhead compared to income.
And the balance sheet reflects that stress. What are the key figures there?
Sources point to low cash. It was $60K at one point, though a more recent mention was $9.45 million, maybe after the capital raise. It's a bit unclear. Low total assets, high total liabilities.
And crucially, negative equity.
Yes, a significant stockholder deficit. That means liabilities exceed assets. It was over $60 million negative in H1 2024, maybe improved slightly to around negative $38 million more recently after the debt conversion, but still deeply negative.
And negative equity is a major red flag for solvency, right?
A huge red flag. It basically means, on paper, the company owes more than it owns. Serious financial distress.
And cash flow must be negative too.
Deeply negative from operations driven by those losses. Last 12 months, free cash flow is reported at negative $25.17 million. They're burning cash quickly.
So profitability, non-existent, liquidity, extremely tight, with a reported current ratio near zero, like 0.01 or 0.02.
Which means almost no liquid assets to cover near-term debts. It's precarious.
And solvency, as we said, is a major concern with the negative equity and debt. They absolutely have to ramp up revenue and control costs.
It's critical for survival, frankly.
But countering this grim financial picture, we have those impressive operational KPIs we mentioned earlier.
Right. The $50 billion plus GMV year-to-date, 13.5 million transactions, 16.5 million monthly active users, tech on nearly 42 million devices, API calls soaring.
These numbers show the system is working and being used at scale.
Yes, but the bridge is turning that into revenue and hitting that $100 million ARR target by year-end 2025.
That ARR target, annual recurring revenue, is key for SaaS companies, isn't it? Predictable subscription income.
Exactly. And going from basically zero ARR to $100 million in roughly a year. That's the definition of hockey stick growth. It hinges almost entirely on Group B delivering that $30 million and Liverpool, Mexico adding its $10 million.
So those near-term quarterly results, like the $1 million revenue expected for Q2 2025 that one source mentioned, become incredibly important signals. Are they actually starting that climb?
Absolutely critical indicators to watch.
And meanwhile, the share price been bouncing around a bit?
Yeah, sources mention it trading between roughly $1.92 and $2.50 in May, sitting around the $2.11 to $2.14 mark as of May 28th.
Volatile. And analyst forecasts still expecting losses.
Yes, consensus EPS forecasts are negative for 2025 and 2026, reflecting the ongoing investment and cash burn needed for that growth push.
Okay, let's pause there for a quick wrap of the first half. We've got Rezolve AI, an AI player in the huge retail market, with tech that seems capable of handling massive scale.
They've got a clear strategy focused on the Group B acquisition and major contracts to finally turn that scale into significant revenue, aiming for that ambitious $100 million AR this year.
But the current financials are stark. Minimal past revenue, huge losses, negative equity, very tight liquidity.
Yeah.
And that shadow of the CEO's history with Power.
It's a story of high potential versus very high current risk and execution challenges.
Exactly. So coming up in the second half, how is the market reacting to this? Who owns the stock? And crucially, what are the biggest risks you need to have front and center?
We'll look at analyst views, options activity, short interest, ownership breakdown, and then really lay out those risks, including that potential tariff impact. Stay with us.
All right, picking back up. Given that high-risk, high-potential picture we painted, how is the market actually viewing Rezolve AI right now? What's the sentiment?
Well, based on the limited analyst coverage mentioned in the sources, the ratings seem generally positive.
Positive. like buy ratings.
Yeah, the consensus seems to be buy or strong buy from the 5 to 8 analysts reportedly covering it.
And their price targets, are they optimistic?
Significantly higher than the current price, it seems. Average targets mentioned are around $5.65 to $6, with some analysts like Maxim Group or Cantor Fitzgerald reportedly having targets up around $10.50.
So analysts seem to believe in the turnaround story, suggesting quite a bit of upside from the current $2 level.
That appears to be the case, based on those reports. Looking at the options market gives another angle.
What does that tell us?
Well, one source mentioned a low put-call open interest ratio, around 0.17. That can sometimes indicate more bullish bets, more interest in calls than puts, but
It's always a but.
the implied volatility is extremely high, around 185%. That's rated elevated.
And high implied volatility means?
It means the market expects huge price swings. Lots of uncertainty is priced in. People are betting on big moves, but they don't know which way. It reflects the inherent riskiness.
Okay, so analysts are bullish, options market expect fireworks. What about short sellers? People betting against the stock.
Short interest itself is moderate, reported around 3% of the float, and the days to cover is low, just over a day. So not a massive short position in terms of shares,
But I sense another but.
but the cost to borrow shares to short them is incredibly high. Sources cited the short borrow fee rate between 87% and 99%.
Wow, nearly 100% annualized. That's astronomical.
It's extremely expensive to maintain a short position. So while the number of shares shorted isn't huge, that high cost could potentially trigger a short squeeze if any significant positive news hits. Shorts might be forced to cover quickly.
Interesting dynamics. So, analysts positive, options expecting volatility, shorts facing high costs. Let's move on to who actually owns the stock.
Okay. Institutional ownership, meaning funds, endowments, etc. The numbers in the sources seem a bit contradictory. Some data providers might show a higher figure, like close to 28%, but the figures based on official SEC 13F filings, which track fund holdings, suggest it's much lower, maybe around 1%.
And which figure is likely more reliable for fund ownership?
Generally, the 13F data is more specific to actual fund holdings, so we'd lean towards relatively low institutional involvement for now, which isn't that surprising for a speculative small cap like this.
Makes sense. The big institutions often wait for more stability.
Exactly. The top names listed, like Man Group or UBS, hold relatively small positions.
But what about insiders? Management, founders, key people?
That's where it gets really interesting. Insider ownership is very high, around 68.71%.
Nearly 70%. That's huge. Who are the main holders?
The CEO, Daniel Wagner, holds over 25%. Another individual, Lichigov Igor, holds nearly 21%. Wickens Bradley James has about 12.7%, Newmark Brooks 11.7%, and an entity linked to an advisor, a parent investment group, holds over 10%.
So ownership is highly concentrated among insiders. What's the implication there?
Well, on the one hand, high insider ownership is often seen as a positive. It aligns management's interests directly with shareholders. They have significant skin in the game.
If the stock does well, they do very well.
Precisely. On the other hand, it means a huge amount of control rests with a small group of people. And, as we mentioned, being an FPI might mean their buying or selling activity isn't reported as frequently or transparently as a U.S. company's insiders.
Right. Sources noted no reported open market buys or sells recently, but that could be the reporting lag.
Could be. It's something to keep in mind.
Okay. We've covered the business, the troubled financials, the leadership history, market sentiment, ownership. Now, let's crystallize the risks. This is clearly not a low-risk investment. What are the absolute key challenges Rezolve AI has to overcome, according to the sources?
Let's break them down. First, financial risks. This is ground zero, the history of massive losses, that negative $172 million in FY24.
And the expectation of more losses as they push for growth.
Right. Which means continued high cash burn. And their liquidity is already incredibly tight. Remember that near zero current ratio. They're reliant on that loan facility or potentially raising more money.
Which carries the risk of more dilution for shareholders.
Exactly. Plus, the debt burden and that negative equity creates significant solvency risk. And the very limited revenue history just makes forecasting incredibly difficult. Huge uncertainty there.
Okay, financial risks are severe. What about execution risks?
These are massive, too. Top of the list, actually hitting that $100 million ARR target by year end. It's such a steep climb.
And that depends heavily on integrating Group B successfully and getting that $30 million revenue contribution they expect. Integration is always tricky.
Always. And if they grow rapidly, can their operations, systems, and management team actually handle the strain? Rapid growth can break things.
Plus, they need to keep winning and keeping those big enterprise customers in a very competitive space.
And they need those big partnerships like Microsoft and Google to actually deliver tangible results, not just be press releases.
Got it. Next category, management risks.
We've discussed the main one, the shadow of the CEO's past failure at Tower. It raises questions about financial discipline and execution under pressure.
And like any young tech company, they're likely reliant on key personnel. Losing a key engineer or executive could hurt.
Definitely. Then, market and competitive risks. The AI in retail space is fiercely competitive. You've got startups, established players, tech giants like Adobe, Microsoft, Bloomreach, Algonomy.
So staying ahead technologically is crucial.
Absolutely. Which leads to technological risks. Could their brainpower LLM be leapfrogged by competitors pouring billions into AI research?
Or could they suffer system failures, performance issues?
Yes. Or, despite their claims, could AI hallucinations or errors creep in and damage trust? And there's always the risk of security breaches with customer data. Standard tech risks, but still significant.
What about regulatory risks?
The landscape is constantly changing. Data privacy laws like GDPR in Europe, CCPA in California, other U.S. state laws, plus potential new regulations specifically targeting AI. These could add costs and complexity.
Okay. And then there was that surprising one, U.S. tariffs? How does that fit in?
Yeah, it's an interesting point raised in the sources. The idea is that potential U.S. tariffs, maybe on Chinese-made AI hardware or software components, could indirectly increase Rezolve AI's operating costs, even though they're UK-based.
Oh, through their supply chain.
Potentially. If parts of their tech stack, or maybe the cloud providers they use, rely on components hit by tariffs, their costs could go up. Sources mention potential 10–20% price increases on some inputs.
Which could squeeze their margins or force them to raise prices for U.S. clients.
Exactly. And there's a secondary risk. U.S. clients might become wary of any supplier potentially exposed to tariff risks and look for alternatives, impacting Rezolve's market access. It's a bit speculative, but a potential headwind.
Interesting. Finally, any listing or share price risks?
Just the inherent volatility we've already seen, and the ongoing risk of dilution from shares held by early investors, or if they need to raise more capital down the line.
Okay, that's a pretty comprehensive list of significant hurdles.
Yeah, it absolutely is. High risk is baked in here.
So let's try to bring it all together. Based purely on these sources, Rezolve AI is playing in a hot market, AI for retail. They have tech, the brain suite. Brain power that seems to handle impressive operational scale, judging by GMV and user numbers.
And they've made big strategic moves, buying Group B, signing major contracts like Liverpool, Mexico, all aimed at finally converting that scale into serious revenue, targeting that very ambitious $100 million ARR for this year, 2025.
But looking at it from a value investing perspective, the current reality is tough. Minimal historical revenue, huge losses, a weak balance sheet with negative equity, and strained liquidity.
And you can't ignore the shadow of the CEO's past with Power. It adds a layer of caution regarding execution and financial management. This is definitively a speculative, high-risk situation, not a stable, predictable investment.
Success hinges entirely on them executing that massive growth plan rapidly and effectively.
Exactly. So what should you, the listener, be watching? Number one, progress towards that $100 million ARR target. Watch those quarterly revenue numbers like a hawk. Are they starting the climb?
You also need to see improvements in cash flow and liquidity. Are they getting control of the burn? Is the Group B integration actually delivering the expected revenue?
And are they continuing to demonstrate a real competitive edge with their technology in that crowded market?
It requires intense monitoring and, frankly, a very high tolerance for risk.
No question about it.
And doing this kind of deep dive, pulling out the key insights from all these sources, helping you understand the core issues, that's what we do here. Which leads perfectly to our hook.
Yeah, the reveal.
We'd be thrilled if you'd like this video and subscribe to the Stock Analytics AI YouTube channel.
So what's your biggest takeaway from this look at Rezolve AI? Does the potential market opportunity outweigh the risks and the management history for you? We'd love to hear your thoughts.
Definitely let us know. And again, please subscribe to the Stock Analytics AI YouTube channel for more deep dives like this.
And remember, for our members, just €4.99 a month, you can give us a ticker symbol, and we'll prioritize doing a deep dive analysis or an earnings breakdown for you, just like this one. We jump on those earnings calls, too.
Now, before we go, the important disclaimer. Please remember, This deep dive is strictly for informational purposes. It's based solely on the source materials provided to us as of May 28, 2025.
We are AI research assistants, not financial advisors. This is absolutely not investment advice. You should always consult with a qualified, independent financial advisor before making any investment decisions.
Investing in stocks, especially ones like this, involves significant market risks. Past performance is never indicative of future results.
We disclaim any liability for any loss or damage that might arise from using this information. All the metrics and share prices we discussed are based on the sources as of May 28, 2025, unless we stated otherwise.
And that analysis about potential U.S. tariff impacts. That's general commentary based on the sources. The actual effect on Rezolve AI could be very different.
Okay, that covers it. Thanks for joining us for this deep dive into the complex story of Rezolve AI.
We'll catch you on the next one.